Good evening, everybody. It's Doc here from OnTheMoneyOptions.com. It's Sunday, February 10th. We're going to look at a continuation of our market manipulation series. This is part 2. We're going to talk first about how the big institutional traders set up for a move down. And then we're going to discuss how they are cloaking the preparation for this move down. And then finally, I'm going to show you how to see it happening, what to be on the lookout for, and what to do to get ready. In the first part, we talked about how capital-weighted indices were constructed, and most people don't realize, but individual stocks have different weightings in the index. We talked about how Microsoft has as much weight in the XLK index as these 39 stocks on the right. So this is just a review. Now what I want to do is I want to actually show you this in action with a demonstration and simulation. In this simulation, we're going to create a little subset index of XLK, and we're going to compare Microsoft with those other 39 stocks. Now on the left, you'll see under the column index weight that I have the actual index weighting in the XLK for each of these 40 stocks. We're going to compare that to an equal weighted index on the right, where every constituent in the index has exactly the same weight. We're going to change the price of Microsoft, and then we're going to change the price of all the others to show you the impact this has. We'll start out by adding let's say today that Microsoft goes up 1%. You can see in the green row there that we had a 19-cent impact on the index with just Microsoft at its current weighting. Now we're going to add 1% to each of the other 39 stocks, and we'll show you what happens there. Even with all of these stocks, and some of them are really big stocks, it only added a total of 16 cents to the index. So the total cap-weighted index goes up 34 cents, while the equal weight index goes up $1.02. Now what we're going to do here is I'm going to show you what happens if the stocks other than the heaviest weighted stock in the index go down. So we're going to let Microsoft go up 1%, and we're going to let all the others go down 1%. And what you see is that the total impact still only created negative 16 cents, and the index change of the cap-weighted index is still up 3 cents. 39 stocks went down 1%, but the cap-weighted index is still up. If you look on the right, you'll see that the equal weight index is down 97 cents. That gets your attention. So we're going to compare these two. Now that you can see how a cap-weighted index can be manipulated by concentrating the buying in the heaviest weighted stocks, we're going to expand our horizon a little bit and take us up to the level of the S&P 500. This chart here is what's called a relative strength chart. The first symbol at the top is $SPXEW. That is the equal weighted S&P 500 index. We're going to have that relative to the S&P 500, which simply means that we're going to take the SPXEW and divide it by the XBX. And then we're going to look at how those two relate. Now, as you look at this chart, you'll see that in late 2016, we peaked at about 1.595, and then we started a steady decline over a long period of time. This decline simply means that the lower weighted stocks had stopped going up and were starting to go down. And as the index went up, there's smaller and smaller number of stocks are participating in that. So this is your first clue that there's something going on that you really need to stop and pay attention. Is the index going up? Is what I'm seeing every night on the Financial News Network mean that everything in the S&P 500 is going up, or is something else going on? This is your wake-up call to take a look at what's going on. In this last chart of part 2, we're going to look at the S&P 500, and I'm going to introduce you to a new indicator. The top pane is the S&P 500, but the bottom pane is the S&P 500 new highs minus the new lows on a daily basis. So each day the new highs and the new lows are subtracted, and if new lows are greater than new highs, the number is negative. If you look at the beginning of the chart in the pretty much all of 2017. You see nice black bars. We were setting new highs. New lows were very small. So this number was very, very positive. Then in early 2018, you see we ran into a little volatility in the market. And you see that there are a number of days where the new lows outpaced new highs. The market sort of calmed down in May and continued up through the September, early October timeframe, where you begin to see the new lows taking over and the histogram at the bottom going down rather sharply. It reached a new low in late November, and that was a real warning sign that something was going on with the market. And of course, the market sort of consolidated there for a few weeks, and then we had a really sharp drop in December. But this indication here in October, November gave you a really good clue that something was really up. If you combine that with the other things that we've looked at, you begin to get a sense that the big institutional traders are pulling themselves out of what I call the second tier stocks and getting the market set up for a move down. So what happens typically is they keep buying the heaviest weighted stocks in an index and keep the market going up, or at least staying level, to make you think everything is fine, while they go down and sell all the lower weighted stocks in the index and clear themselves out of those first. And then they know whoever's the first to go out at the top makes the most money. So this is how the market sets up for a correction or a move down, and this is a way that you can see it. One of the reasons that markets seem to fall so precipitously when they go down is a lot of this has already been prepared. This correction has been prepared by removing the small cap weighted stocks out of an index. They've sold those positions. The only thing really left are the high cap weighted indexes. So when they start selling those, the market tends to recede very quickly. So this is a way to see what's going on in the market, something other than just looking at the S&P 500 and thinking everything is fine. So next week we're going to talk a little bit about how the institutional traders can manipulate the close prices a little bit to help them make you see what they want. So anyway, this is Doc from OnTheMoneyOptions.com, and until next time, trade smart, stay hedged.